Hey, welcome back, everybody. This is going to be part 3 of a 4-part series that I'm putting together around trading options on Robinhood for beginners. If you haven't already checked out the first 2 parts or the first 2 sections, please, I suggest you do that. I'm going to provide the link to the first video up top so you can reference that. As always, if you could subscribe to my channel, I really appreciate it. The more likes and comments that I get, the more exposure that I get, and I really do appreciate everybody's help in doing that. So please like or comment on the videos as you're watching them. I really appreciate that. So in this section, part 3, we're going to talk about implied volatility, which we talked about a little bit in section 2, but now we're going to talk about, what makes up implied volatility, what are the details around it, and why is it impacting things like intrinsic and extrinsic value that make up that premium price. Okay, so 2 quick things, right? Implied volatility is great for stock options, okay? Implied volatility gets those premiums to start rising very quickly. The other thing is the option that you purchase can never be worthless before expiration, right? So the max that you would lose is the premium that you would pay. All right, so just keep that in mind. Those 2 things are really, really important. So as we transition over, right, so we're going to talk about implied volatility. And what I'm showing you here is kind of like a trending chart, an implied volatility graph, if you will. Right, so let's just say at expiration, we're right before expiration, your contract is worth now 1 cent, or for 100 shares is $1. And implied volatility, from the time that you bought the contract, was kind of steady. Didn't really go very far. And as time, continues, that extrinsic value is going to start decaying. So your total premium is going to start decaying, right? So if you paid $100 for the premium, and the stock price hasn't changed, implied volatility hasn't changed, that premium value that was $100 is now going to start to drop. So let's just say you bought here for $1, $100 in premium. We'll just say $1. That's where you bought the options contract, and you went along, implied volatility's not really picking up, right? Let's just say now implied volatility starts going like crazy, all right? Starts going absolutely nuts, okay? Now it's getting closer to the expiration of the contract. Maybe there was some news about the underlying stock that's creating a lot of buzz now around it, right? Implied volatility starts going crazy. Now, if implied volatility, right, is down here, what is your contract worth? It's still worth only 1 cent, right? Because you can't lose more than you actually paid. However, if implied volatility gets up to here, right, now your contract is worth $2 or $200 since it's 100 shares. Or implied volatility gets up to here, now it's worth $4. And up here, it's worth $8 or $800, right? Remember, you bought it here at $1, right? So when it gets to here, it's worth $8. You could then sell that option for $8 and make that's an awful looking 8. Right? Sell it for $8. You bought it at $1. That's a $7 profit times 100 shares. That's $700 now that you have made and you can put into your pocket. Right? So implied volatility is really great for options. So when you're looking for different options to buy, look for options that have high volatility, high implied volatility, and high volume. We'll talk about that in section 4, but just so you get the idea, implied volatility is extremely good for options. As you can see, as implied volatility goes up, the price of that premium is going to go up that you can then resell for and make a profit. If implied volatility goes down, remember the premium is going to go down. However, you can't lose any more than you already bought it for, right? So that's really good. So the longer you have that, the longer the expiration, the more you're going to pay in premium, but the more time it allows for that implied volatility to start kicking in for people buying and selling the actual stock and the options. All right, so part 3 was kind of a quick one, right? I didn't want it to go into too many details around implied volatility because it can get really complex, but I just wanted you to understand it from a conceptual standpoint, right? So there are 3 pieces that I want you to take away from this video. The first one, why is implied volatility good for options? 2, why is it called implied volatility? And 3, how is the premium affected by implied volatility? If you can understand all 3 of those things, great. You're past what you need to know for moving on to section 4. Again, section 4 will be covering more of the details around the options, some of the terms and how things like the premium and implied volatility kind of are affected as the options get traded. Again, if you like this video, click the thumbs up icon down below. Add some comments in the comments section. Feel free to subscribe to my channel. Again, I really appreciate everybody that subscribes and likes and comments. It's great. And also, it helps me understand how to make these videos better. Feel free to check out the description below. It has some information around my Discord group that I have. If you would like to help support the Discord group or this channel, feel free to use my referral link to sign up for Robinhood. Also, you could send some donations to my Venmo account at Jonathan Van Horn. Again, everything is really appreciated. I really appreciate all my fans and my viewers. So again, subscribe, like, comment, and help support. And until next time, happy trading.